Welcome to the Techno Fundamental Report for February the 5th. Bulls make money, bears make money, but pigs get slaughtered. We've been talking the last couple of weeks about trying to stay focused on a specific strategy because when you start to chase what is hot, it can really backfire on you. So the danger of chasing performance goes back to the Egyptians. It's an old problem. So speaking of chasing something, we have gold and we have silver. And we all know that in the media, there's been tremendous press on these precious metals. Why they're doing what they're doing? Well, being that I'm a focused investor on growth stocks, it's very difficult for me to shift gears and go, I completely understand the commodity markets. I understand the growth markets. So when you start deviating from what you know, just like Warren Buffett has always said, you'll get in trouble. So one of the ways to handle parabolic moves, so you can see both here in gold and silver here. You want to use point and figure charts on parabolic moves because you can clearly see the parabolic move. But you can also see that this has really been going up for a long time. So it's kind of late stage. In other words, the word's out. So one of the ways to handle these types of graphs, now let's look at silver for a second. You get a major rally. And so I would say to myself using this, I'm looking for a trend reversal here, especially after such a lengthy time of climbing and a ridiculous amount. So, this is an auction market. Remember, that we're dealing with buyers and sellers. So one of the ways you handle point and figure is you use something called a high pole sell signal, which is where you get the parabolic move. If it retraces over half that move, that's a high pole sell signal. However, that didn't happen with silver. It rallied, pulled back, then rallied again, made a new high, and then totally collapsed and gave a sell signal right here around 95. Now, it has dropped dramatically, breaking the chart. We have gotten a rebound. So what I would be looking for would be some type of consolidation, but if it continues to break down, I'd have to rethink my position. Risk on, risk off. Now, if you've got risk off, it's like swimming against the tide. It's like putting your hand on a hot stove. You cannot really make money when a majority of the buyers and sellers are in a risk-off mode. So how can we determine that? Well, let's look at a couple of things. One is Bitcoin. I mean, you talk about risk. This is a risky deal. You've got a high here, a lower high definitely in a downtrend, risk off. So this is kind of a indicator for risk on, risk off. So anybody that's crazy enough to do this stuff is risk on. Now this was a report written recently about an indicator we've been using called the number of new lows on the New York Stock Exchange. When they get over 40 a day over an extended period, it's telling you something. Now the group that I work with that did a back study on this said as long as the number of daily new lows did not exceed 40, the market was sound and no danger of falling significantly. And remarkably, this specific threshold of 40 new lows remained the same over the entire 50 years we studied. So all these indicators that we use are provided to us who do back studies, and we're talking 50-year back studies. Some of them are 100 years. But basically, the indicator is a daily reading of what the market itself is doing. That's one benefit. It's extremely broad-based. It's the entire New York Stock Exchange. Using our guidelines, you get simple, unbiased readings of health of the market every day. So nothing is black and white. Nothing is perfect. These studies prove to be particularly helpful during normal markets and at market tops, and most importantly, at market bottoms. So in other words, think about it. If you're at a top in the market and you start getting a lot of new lows overall, it's telling you there could be a problem out there. However, when you're at a low and you start to see the number of new lows dry up, Well, that could tell you that we're getting ready for the next major advance. So right now, as of most recently, we're getting a substantial number of new lows, which is a early warning. At times like these, maintaining emphasis on capital preservation versus capital appreciation can take precedence. And it is best to have a plan in mind beforehand rather than reacting emotionally when selling reaches a potential advanced state. Now, we talked last week about the aggression index. It's a very important indicator. Again, we have back tested this indicator for many years. So what we're doing is we're just simply saying, okay, if risk is on, the NASDAQ is going to win the day. If risk is off, consumer staples, things that are safe, things that have no real potential, but pay dividends and have low PE ratios, and I'm talking like Campbell's soup, that kind of thing. So if that's where you want to, bet your future on, I wish you luck. But I did it in the past, back in the early 80s. I basically did that type of strategy, and I really just didn't get anywhere. And then I started buying Cisco systems in 1995, and everything changed. So on the aggression index, we are seeing some troubling signs here. It's making fresh lows, which means that the NASDAQ is dropping more than the consumer staples, or more importantly, the consumer staples stock are breaking out to new highs. Now, again, these are dull, dividend-paying, low PE ratio companies. Now, when an institution is running for the doors, they're going to start shifting their portfolios into consumer staples. Now, realize, too, we always recommend that you look at least 5 indexes because the indexes can be very deceptive, especially the Dow. Now, if the Dow is full of consumer staples type stocks, which it is, you're going to see the Dow doing well, which could be very deceptive because everything else you can look at is telling you things really aren't doing that well. So here's the IPO Renaissance Fund. It's an ETF that invests primarily in companies that have gone public recently. High back here in September, a lower high in a downtrend, breaking down significantly. So if you're seeing the Dow going up, it's telling you that the growth stocks are lagging behind. And if you think the Dow is your main source of information, you may have a problem with that. Now here's China. This is the Crane shares, another ETF for Chinese stocks. You can see really starting to break down here. Here is NVIDIA. NVIDIA has been the big leader over the last 3 years. The stock is breaking down. The old low is around 170. If it breaks below 170, and it's at around 173 right now, this is very important because this could indicate that the AI growth spurt is coming to somewhat of an end, which could have a dramatic impact on the overall market. So we just have to be aware of that. Here's semiconductors in general. This is another ETF, the VanEck Semiconductors. You can see here breaking down. Now, this could all change tomorrow. But right now, like I've always said, I can only tell you what I see. And this is what I'm seeing, which I think is very important. This is a ratio. I'm taking the small cap stocks by the S&P 600. Now, these are higher quality small cap index, usually companies around 9 billion in market cap. And I'm comparing it to the Magnificent Seven, the Vanguard Mega Cap Growth, which is the Magnificent Seven. Now, you can see here, since 2023, the small caps have been grossly underperforming the Mag 7. The Mag 7 have driven the whole market for the last 3 years. So do you jump into the Mag 7s? Well, what if this shifts? And it looks like it's shifting to me. In other words, if you go back and look at every time we've gotten a rally in the small caps, it quickly fails. Rally in the small caps, it quickly fails. But this time, we're not failing. In fact, we're making a new high, and we've gotten the golden cross. So this is on the small caps. Now, let's look at the mid caps. Same story. Now, these are just a little bit bigger. They're not in that large cap group that we're looking at here, but you can see they've been underperforming dramatically. But now we're starting to see some change of direction. So if you're saying, okay, it's door number 1, door number 2, or door number 3, where door number 1 is growth stocks and door number 3 is, let's say, large cap, mega caps, are you going to switch from 1 to 3, or are you just going to sit tight, or are you going to make some changes? I'm saying that we're seeing a shift here that could be meaningful. So let's just take a look at where we are today. NASDAQ is breaking down below the moving averages. That's not a good sign. Yesterday we got some pretty heavy volume to the downside. S&P is holding up better. It's holding the 50-day moving average, however, is somewhat cracking. I'm just saying that if the growth stocks crack, there's a tendency to take everything with it. So if you have any questions, please let me know. Thank you very much.